welcome to the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, it is, you guessed it, the Feel Good Edition.
Yes, excellent.
So it's about September 30th, end of the quarter, and we have some good stats here. The S&P year to date is up double digits. And when that happens, Jim, it's usually a good fourth quarter.
Yeah, definitely is usually a good sign for the rest of the year.
So this has happened like 30 times since 1950, where the S&P is up double digits at the end of the third quarter. And what's interesting is October has actually been negative on average thanks to 1987. But it is October 50-50. Like 50% of the time it's up, 50% of the time it's down. So that's a coin flip. But the fourth quarter as a whole is up 83% on average, right? So that's even better than average. And the returns are great. The average return is 4.3% and the median at 5.2. Looking at this data right there. And that is excellent, right? That's way above average for a quarter.
Yeah, definitely. And the fact that it's proven true 83% of the time is a pretty strong statistic.
Yep, definitely. So it's been a good year, and usually, when a trend is really strong, that trend continues for a while. So hopefully we'll have a strong fourth quarter. One other thing with market timing news is that we're up against the government shutdown threat once again. So this has happened many times in my career, especially since 2013. But I don't want you to get upset about this. I don't want you to panic. I want you to keep your focus on numbers like this rather than the emotions of a government shutdown, because typically doesn't happen, but then if it does, it's typically quick. And in the 4 or 5 times that it has happened in the last 10 or 12 years, I looked this up, the average returns over the next 30 days are very similar to what we've seen here, where it actually leads to a market spike. I don't know why, but for whatever reason, it's an atypical expectation, I guess.
It probably puts people in a good mood, thinking, okay, we're still going to be all right. We're not going to shut down everything.
So if you have questions regarding the government shutdown, call us. Let's leave it at that, okay? All right, so today we're talking about beneficiary IRAs and the strategy that we like to recommend when we're making withdrawals from the Bene IRA, and also the investment allocation or the investment risk that we could have in this type of a situation. Now, we've seen more and more people that are young, like 30s, 40s, with large IRA balances. So maybe there's an unfortunate early passing of a parent who contributed to their 401k for 30 or 40 years, and they never got a chance to use that money, and so the kids end up with it with a large balance.
Yeah, and keeping in mind the new distribution rules on it is that beneficiary IRA has to be depleted within 10 years. So if your parent was young and they were not yet taking a required minimum distribution, that means you don't have to either. You just have to deplete it by 10 years. So there's some interesting nuances to the law for people who inherit, when their parents passed at a younger age.
Okay, so what if it's a great big IRA, right? What if it's a couple $1 million, which, if you contributed to your 401k over your career, it definitely could be worth that much. And let's say they were 70 plus and they were taking required minimums. That means I would have to take a required minimum. And I might be tempted to just take the minimum because I'm working and, I don't need that money, right? Because I have a job, right?
Yeah, because anything you take out is added on top of your income. So if you're already earning and in a good tax bracket, it's just more money right on top of that.
Yeah, so I could definitely see myself being tempted to just take the minimum, okay? So let's say the IRA is worth, $2 million or something like that. The required minimum is like $45,000, depending, just coming up with an example, depending on my age and my life expectancy, the tables could end up like around $45,000. Well, if you only took out $45,000 on a $2 million portfolio over the next 10 years, that portfolio could be worth $4 million, right?
Yeah.
I mean, let's just say it's probably going to be worth a lot more than it is today.
Yeah.
Even if you're taking out some. Okay. Well, let's say I'm like in the 22 or 24% tax bracket, and I'm taking out $50,000. That's a pain. I'm paying out, upwards of $10,000 between the Fed and state. So that's painful. But I'm still getting, 40 grand into cash flow, which is nice. But then I'm going to have this $4 million bomb that goes off in 10 years. And that's going to be taxed at the 37% bracket, almost like probably at least 3 million of it.
Yeah, for sure.
And so this is a real conundrum for people.
Right. Yeah, how do you get the money out of there in the most tax efficient way? And waiting till the end like that, now the bulk of that money, now you just paid the highest rate on.
Yeah, so we have to figure out how to get it out at a lesser rate. And so what we counsel people to do is take actually larger withdrawals right now. It doesn't necessarily have to think of it like 1/10 each year, but we're in the right direction when we're doing that. The 24% tax bracket is very large. So we could take a ton of money out each year and be taxed at 24% and have much less left in the 10th year, which would be subject to potentially that 37%. You could even maybe take it, so you could also even venture up into the 32% bracket if the IRA was big enough to avoid the 37. And so this is not tax advice, but it's tax planning discussions for educational purposes only. But I think that we can save hundreds of thousands of dollars in income taxes by having, a progressive strategy dealing with this plan. Yeah, having a plan dealing with these big IRAs.
Yeah, I agree completely. Just like we talk about with Roth conversions and things, we don't want to leave unused money in a good tax bracket. Right?
Exactly.
We want to maximize the opportunity that we have there.
Now, we also see people that have brokerage accounts, right, in addition to these beneficiary IRAs. And maybe the brokerage account is invested more moderately because they think, well, maybe I'll need that money for something or I'll need that money sooner. And I have my beneficiary IRA invested aggressively because my brain is wired for IRAs for aggressive, right?
Right.
Well, let's kind of turn that upside down because the reality is you do need money out of this beneficiary IRA immediately. Every year you're going to need at least a minimum amount. And if you're working with us, it's going to be larger than the minimum, probably. And so that account actually needs to have, like we talk about the peak income conductor, a strategy in place to make sure the risk matches the timeline. So maybe it shouldn't be aggressive. And now as we're taking these distributions, these large distributions, it's probably more money than we need because we're working and we're not relying on that money. And so we put that money in a brokerage account.
Yep.
Well, if that brokerage account, again, is money we don't need because we definitely won't need it because we're drawing down the IRA. So the brokerage account then can be aggressive. And if we are pushing ourselves up into this 24 or even 32% bracket, any fixed income that's invested in that brokerage account is going to be taxed at that higher level. So let's get it out of there and be more aggressive in this account. And so we're only paying tax on stock dividends, which could be at 15% or 20%. And so it kind of turns that risk reward or that risk allocation of risk to different accounts kind of upside down.
Yeah, I think it's really a great idea. In a taxable account, there's so much more. There's just flexibility with it, right? And what you can do with the gains in there, and using ETFs to continue to defer. And maybe you hold that account forever, and now your basis steps up when you pass it on to the next generation. There's just a lot of advantages there, and to make that a really good idea.
Absolutely. So if you have a beneficiary IRA, reach out to us at peakwm.com and schedule a second opinion online with us. And if you haven't already, please ring that bell, subscribe, and if you found this topic interesting, please share with your friends.